All right, let's jump right into this explainer. Today, we're putting a target on the absolute most dangerous metric sitting on your executive dashboard right this very second, the win rate. If you're managing quant teams or directing capital, I guarantee you've had reports slide across your desk hyping up these supposed miracle strategies. 80, 90, maybe even 95% win rates, right? It looks incredible on paper. But, as we're going to see in the data today, optimizing just for a high win rate is literally the fastest mathematical path to losing the whole shebang.
Which brings us to our first core concept, the mean reversion trap. Take a look at this number, 90%. We're going to look at the very real story of a trader who flaunted an absolutely pristine track record right up until the market fundamentally pulled the rug out from under them. They were running a delta-neutral funding rate arbitrage strategy, and throughout early 2022, they were hitting that insane 90% win rate. Day in, day out, the system hummed along exactly like it was supposed to.
They were just farming these tiny, really consistent little premiums, pocketing maybe $200 a day, posting screenshots of their green closes on social media like trophies. But here's the catch. Because win rate was literally the only headline metric they were paying attention to, they were totally, completely blind to the massive systemic risk quietly piling up in their portfolio's left tail.
And then, boom, May 2022 hits, and we get the Luna crash. That quick little bounce they were betting on? Yeah, it never happened. One single unhedgeable left tail event completely vaporized over 1,200 of those tiny successful trades. It instantly liquidated the entire account. Look, this wasn't an execution bug. It was a fundamental failure of measurement.
And this perfectly highlights a massive structural flaw in the industry. It's the exact same flaw we saw play out again on October 11, 2025. Look at this figure, $19.35 billion. That is how much was wiped out from market makers in a sudden flash crash. These were serious institutions running those exact same high win rate mean aversion strategies. They thought they were safe because they won 9 times out of 10, but they completely ignored the fatal, catastrophic cost of that one time they were wrong.
Or, think back to Black Thursday, March of 2020. Remember when Bitcoin just absolutely collapsed down to $5,678 in the span of 15 minutes? That violent move totally shattered cross-exchange arbitrage systems that practically live at a 95% win rate. The takeaway here is absolutely crucial. High win rates are structurally deceptive because they completely hide the deep asymmetry of the market.
So let's unpack this further. What exactly is the win rate hiding?
To really grasp this, let's talk about the base rate fallacy. Look at this donut chart right here. If you're looking at a 1-minute Bitcoin bar, actual, tradable, actionable signals exist less than 5% of the time. The other 95%, it's just pure market noise. So think about what that actually means. You could have a horribly designed model that literally just says do nothing all day long, and it would technically hit a 95% accuracy rate, but obviously it would be completely useless to your bottom line.
Let's move on to the executive's error map. How do we translate this abstract data science jargon into real, hard-hitting C-suite logic? Well, we map the errors. Take a look at this matrix. A true positive, that's simple, that's realized profit. A true negative, capital preserved. But the real secret sauce here is in isolating your errors. A false negative is a brutal opportunity cost, while a false positive is a literal paid-for mistake that carries massive cascade risk. Let's break those two down. A false negative happens when your model basically falls asleep at the wheel. It predicts no move, but the market absolutely takes off without you. It is the ultimate opportunity cost. Think about missing the post-halving Bitcoin rally. When it ripped from 28,000 to over 73 grand. That is a gargantuan false negative. A miss like that dwarfs years of tiny incremental wins. Depending on how your strategy is built, that kind of miss can be totally fatal.
On the flip side, we have the false positive. This is your model predicting a move that just never materializes. It's essentially stepping right in front of a falling knife, betting on a bounce that's not there. This is a paid-for mistake with asymmetric damage. It walks your strategy into larger and larger losses that, just like we saw with the Luna crash, can literally blow up your entire account.
Which brings us right to the classic quant trade-off, precision versus recall.
Depending on your specific trading style, you should actually be terrified of one of those errors way more than the other. It really comes down to this dichotomy. Are you an aggressive trend seeker, hunting for those rare, explosive outliers? Or are you a conservative mean reverter, just quietly farming small grid margins while relying on market stability?
Let's say you're the trend seeker. Your portfolio is what data scientists call recall-dominated. Your whole economic logic is that missing the big outliers destroys your entire edge. So you can happily eat a dozen small false alarms, and yeah, that's going to give you a technically low win rate. But if you miss that one singular massive regime shift, you're not paying the year's bills. So your mantra is all about optimizing for recall. You'll tolerate the noise to catch that 10x rally.
Now, the mean reverter, total opposite. They are precision-dominated. Their underlying logic is that bad entries accumulate catastrophic left-tail damage. They would honestly rather sit on their hands and miss a few decent bounces than enter a single false positive that sparks a liquidation cascade. So they absolutely must optimize for precision. Their mantra is, I would rather sit out 90% of setups than catch a falling knife.
All right, so how do we actually fix this reporting? Let's talk about the F1 score dashboard.
If the win rate is basically lying to us, how do we build a dashboard that gives the C-suite the raw truth? The answer is the F1 score. Mathematically speaking, it's the harmonic mean of precision and recall. Think of it as the golden middle ground for environments where signals are incredibly rare. It severely punishes these one-sided, lazy solutions. If your quant team brings you a model with 99% precision but only 5% recall, it's going to have an absolutely abysmal F1 score. It instantly exposes the exact weakness that a high win rate would normally sweep under the rug.
And it actually gets better. Advanced algorithms can take this a step further using what's called the F-beta score. This is a real game changer because it lets you mathematically encode your firm's unique cost asymmetry right into the model. It's literally like having a custom risk slider. Trend followers can use an F2 score to heavily bias toward recall. Mean reverters can use F0.5 to weight precision. It customizes the entire dashboard to perfectly match your specific institutional risk appetite.
So, because of all this, your standard research panel simply has to evolve. We need to stop letting win rate lead the conversation. A modern, robust C-suite dashboard needs these high-dimensional metrics. We're talking row and column normalized confusion matrices. We're talking precision recall curves to actually prove the signal quality. And all of that needs to be paired directly alongside your standard equity curve and drawdowns to show the real monetary impact. All right, wrapping things up. I want to leave you with this one provocative question to take straight back to your quant teams tomorrow morning. Is your dashboard tracking win rate, or is it actually tracking survival? Because as market history proves over and over again, optimizing strictly for win rate is honestly just a delayed recipe for liquidation. Start measuring the errors that actually matter, and you'll build strategies that truly survive. Thanks for hanging out with us on this explainer, and we'll catch you next time.